Yeah, this is Chris Marabella, Net Lease TV. Today is Wednesday, July 31st, 2024, and we're going to be listening to Fed Chair Powell's interest rate decision testimony. He's going to be testifying shortly. Right now, we've got the 10-year Treasury right around 410. It's down from 447 in June, right around June 30th. So it's down a good 40 basis points. And I would say our business was pretty slow from April to probably around June 10th. And then it really picked up on the anticipation that the Fed will probably start to cut the federal funds rate in September meeting. Also, it doesn't hurt that the election is in the third quarter. So on anticipation of that potential federal funds rate cut, which the federal funds rate right now is at 5.25 to a half. That's a 23-year high. And personal consumption index, that's one of the indexes that the Federal Reserve watches pretty closely, has been coming down. It's right around 2.6% annually. So inflation and employment are coming into more equilibrium. The Fed's really looking for that Goldilocks, not too hot, not too cold situation. We just apped a Walgreens property. We're doing a 30-year amortization fixed for 5. That's with a CMBS lender. The client needed more proceeds than we could get with a portfolio lender. We came in right around 4.7. We're in the low 7s on a 5-year fixed. He wanted non-recourse, and we got non-recourse with standard carve-outs. And then we're also apping a Chipotle property, and that's coming in right around 6 5/8 on a 5x5 with a 30-year AM, and I believe that's right around 1.5 to 1.6 million. So on anticipation of the Fed possibly cutting rates, there's been a rush for net lease acquisition, refi, cash out, takeout, and construction financing. What we believe is as the short-term rates fall, the federal funds rate falls if they lower rates. Short-term rates, 1-year CDs, 1 and 2-year treasuries will drop, yields will drop, and then investors will go farther out on the curve for yield, and that will most likely make the 10-year treasury drop. The 10-year treasury yield is normally used as the most common index out there, and I would say right now we're right around 200 to 300 basis points over that index, which I believe is right around 4.10 right now. So we're just waiting on Fed Chairman Powell's testimony, and we'll comment as soon as he starts speaking.
Good afternoon.
All right, there's Fed Chair Powell.
Squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%.
That's good news. Down to 2.5 now.
Returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
So they're going to keep the rate unchanged at that
restrictive stance of
5.25 to a half
in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP
good news.
Moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%.
Less employment, less inflation.
Couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years.
And that's probably because Biden's just left the border open, so there's more immigration, illegal immigration coming in, more workers,
excluding the volatile
dropping, some of the
PCE
inflation.
rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
We're definitely a forward indicator, and if
the committee will
that's
carefully assess incoming
but
data,
there's a 2-month lag, so economy should be stronger around the election. So that should be interesting to see.
Monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, here goes the questions. They're normally more interesting than the testimony.
Gina,
so let's listen in.
Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this.
That's a good
We have
question.
made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So it's kind of more the overall, he's going to make a decision on more than just,
that the broad sense of the committee
he's going to look at the overall situation and make a decision. That meeting's going to be on September 17th or the 18th. We'll have to verify.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more.
I would say if homelessness is a reflection of the economy, we're seeing more homeless people. I know I was in LA and San Diego, Inland Empire. I'm seeing many more homeless people. So I got to believe the economy is definitely weakening. It just seems like there's more distressed people in the street right now.
Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know.
So there you go. Federal Reserve keeping the federal funds rate at 5.25 to a half. Next meetings around September 17th to 18th.
We had to focus on
Jerome Powell saying that he's not going to look at one metric. He's going to look at everything in September to see if they're going to lower rates.
As I said, we're prepared to
we think that long-term rates will probably go down and short-term rates go down as investors look farther out in the curve to get that
one statistic, although
continued yields.
The unemployment rate is
so that could actually benefit long-term rates.
A good single statistic.
We're seeing a tremendous pickup in financing for net lease properties.
Surveys,
probably starting around July 10th to the 15th.
But we're looking at
and think that we'll be closing, if everything works out, we'll be closing deals
conditions,
right around, from September to November, right around the election.
I think inflation
pretty interesting. I don't know if there's
below 2%. So
the Fed's being political here, but it's kind of an interesting coincidence that now they're thinking of dropping rates right before the election. So if you need net lease financing, give me a ring.
Cooling
760-803-6464, 760-803-6464. Text me on my cell if you'd like, 760-803-6464, or
down to 2%.
Send me an email at @marabellafinance.com, and we'll look forward to hearing from you. Thank you so much.